Welcome, everybody, to today's Powerplay Tuesday with Quest Trust Company. I am Kurt Power, the Business Development Manager and one of the IRA specialists with Quest Trust. Very excited about today's topic. It's one that we have not had in my time at Quest, going back 4 years, talking about student housing and why this multifamily niche is beating your traditional multifamily investments with my good friends Brad Seidel and Biff Ramsey of Burton Capital Group. I'm going to teach you guys everything you need to know about why this is a good investment vehicle to add to your portfolio. And I think what you're going to learn is there's some predictability in the income stream. And as you all know, as business owners and entrepreneurs, the better we can predict our income, the better and more efficiently we can run our business. So very excited to have these guys on. But first, just some housekeeping. As you guys know, presentations at Quest Trust Company are simply for your education. We don't provide any tax, legal, or investment advice, nor do we do any kind of structuring or entity creation. Our job is to educate you and lead with education. We encourage you, the investor, to do your due diligence, consult your CPAs and attorneys to give you that extra bit of confidence that the investments that you choose to do in that IRA are truly for the best benefit of your retirement. If you're new to self-direction, welcome. It's a pretty impressive and powerful vehicle about what you can do with a self-directed IRA. The biggest thing you want to know, it's not a type of IRA, it's just a marketing term. Same IRA at Fidelity, same IRA at Quest. The difference lies in what you can invest in. In our company, Quest Trust, we're very big into real estate, private placements, note investments, and that fits right into the wheelhouse today of Burton Capital Group being a private entity. Take your self-directed IRA and learn how to utilize that for your tax benefits, or even better with a Roth IRA, some tax-free investment dollars for your future. With the thought of your future, take control of that financial future, scan this QR code, get in touch with the IRA specialist at Quest. We are here to help you. We're here to serve you, teach you everything that you need to know mechanically about what you can do and can't do with the IRA, and get the thought process working. The education you're going to get today from Brad and Biff are going to go a long way to maybe making that selection on what that next investment will be. So without further ado, I'm going to add my friends Brad and Biff to the stage right now. How you guys doing today?
Hey, Kurt. Thanks for having us today.
Anytime, doing great. Man, I'm excited. Our mutual friend, Beth Underhill, I got to give her the credit for bringing this to the table. Why I'm so excited about this, and we talked about this before we came on, is that it's, in my opinion, an underserved asset class, but it's an extremely powerful one. You know, we think about student housing, and I alluded to it to you guys. You know, I come from the self-storage world, and there's so many parallels with this. So many parallels of the drivers of income, ancillary and otherwise, as well as the predictability of when we know we're going to be making our money. But with you guys, you got the cherry on top that just because the house is not occupied, or the house, whatever, is not occupied, you're still getting paid. They're 12-month leases. So I think that is something that beats traditional or even non-traditional asset classes, is that it doesn't matter if it's occupied or not. You guys are making money, and then the investor's making money. So win-win all around. Last thing before I get off of here and let you guys take it over, we do have the chat. If you have questions, put them in the chat. We've got Sarah Shellam on to answer any questions that you have, but we're going to save the questions for Brad and Biff towards the end of this. We'll read through every one of them. I anticipate we're going to have a lot because we have a pretty good turnout today. So that's enough out of me, guys. Take it away, and we'll see you guys at the end.
Awesome. Yeah, thank you, Kurt. You know, we really take a lot of enjoyment in educating people on student housing, right? Because especially, what better time, right? It's August. A lot of kids have just started the academic year or about to start. And there's so much out there that we hear, since we're in this space and have been in it for so long, just so many misnomers, right? So this is a really exciting space. It's a niche within multifamily real estate. And yeah, I'm very excited to be here. My name's Brad Seidel. I'm a United States Naval Academy graduate, was a Navy pilot for well over a decade, worked with SEAL teams and Marine Corps Special Forces, some of the best and top teams in our country. And I was able to join a team, Burton Capital Group, with Biff here, our co-host here. And it's just very important to continue to surround yourself with top performers, and excited to hopefully educate some people here today, and at least, if nothing else, understand that there's something else out there for your repertoire as you're looking across the spectrum, and maybe you didn't know about it. So as Kurt had mentioned, right, we've got a student housing as a niche. It's outperforming multifamily, right? Traditional multifamily that you're used to seeing, the big apartment complexes. So we're going to dive into why that is. What is, we're not just going to sugarcoat it, because like any good investor, a lot of this due diligence that you guys are doing today, hopping on, it's very appreciated. You're such smart investors to put the time in, understand that this is your due diligence, and asking questions at the end is just as important as hearing these. And I hope we can have a nice, thorough conversation with that. But to kick it off, students are always going to need a place to live. When you go off to school, and my co-host Biff here, which I'll introduce shortly, but he's got so many stories about COVID and how kids originally were trying to do this from home, and it just doesn't work. So we'll dive into that more. But it is nice knowing that these units will be occupied because they need a spot to live. Student housing is what's important to understand and the big picture here, you're looking at not a mixture of some, call them regular townies, you might hear that term called, but regular families or individual. These are purpose-built, mission-driven, in the sense that these are for students, specifically built for students, and their layouts are a little different. And it's going to attract just the student population, potentially young professionals just graduating as well. We've seen that as well. But again, these are buildings and properties that are built for this rationale. Without further ado, I do want to introduce my teammate Biff. A big part of our success as a company and our track record is really from his, right? Look at how much he's dispossessed in this world, working with Landmark, who's I believe the largest owner, third largest operator of student housing in the country. And so without further ado, I want to introduce Biff Ramsey.
Hey, everybody. Excuse me. Welcome. Thanks for having us. Thanks for the opportunity. Glad to be here. Glad to be speaking with, excited individuals. And as Brad said, y'all consuming this content and wanting to grow your knowledge base and hopefully, find some more avenues for yourselves is an amazing thing. And I applaud you. And again, thanks for the opportunity for having us. Yeah, I come from student housing operations. I spent almost 20 years working for developer, student-specific, purpose-built, mission-driven student developers, the biggest developers in major markets in this space, developer, owner, operator. So, they went from, concepts on a whiteboard all the way through pre-development, development, construction, delivery, lease up, stabilization, and ultimately dispossession. Done that for many, many years, seen some big, beautiful machines, is what we like to say. And, we're elated to be here, having created our own machine and looking for, always looking for new partners, new friends, new avenues. And, super proud of our portfolio that we have here at Burton Capital, and can't wait to explain more about student housing and the nuances and the niche and the pitfalls and just everything that kind of comes with the student-specific corner of the multifamily space.
Yeah, well said. So what's so important about stuff like this, we want to hop on and hit not just obviously there's a lot that we're going to talk about that are great, but we're going to talk about what's the difficulties of it. And also a lot of the misnomers, as I mentioned early on, right? There are a lot of myths to student housing that I personally didn't know about until joining this team and understanding it more. The first being this animal house. I didn't even want to get into this world personally, because in my head, I keep imagining these parties and this damage everywhere and just a total mess, right? Just like in the animal house, John Belushi is going to be one of my tenants. So I really was a little leery of it. There's plenty of risk mitigators that are in place that are, and not just this is sector wide, not just from our company, but I would say the best and the strongest risk mitigator we have is the fact that these students have their parents signing on the leases, right? They are the guarantors. So the students are not the ones signing. We're not, yes, we deal with them technically directly, but indirectly, you're really speaking to parents. You're really speaking to, and in our case with the Class A, which we'll get to our strategy more, but we're talking to parents with, 780, 800 plus credit scores. They're not willing to, they're not going to risk their credit score over a few issues. So having that backstop, it's, traditional multifamily does not have this. Right. If you have someone that's in your apartment complex and they decide not to pay, or they decide to wreck something, I mean, you try your best with them, but being able to have a highly qualified co-signer is a huge risk mitigator, and is a big step towards why I'm such a huge fan of student housing.
Yeah, no, it's true. The industry a long time ago, I mean, 30 years at this point, moved from more of a joint and several lease structure to what's called an individual lease structure. That means that every roommate in every unit is responsible for their account, their bedroom, and their pro rata share of the common area, and that is co-signed by a qualifying sponsor or guarantor. So to Brad's point, you can damage it all you want to. You're going to pay for it. Someone of means and of qualification is going to pay for it. And I have horror stories. I mean, I had kids take a chainsaw to an interior wall one time and make 2 4-bedrooms into an 8-bedroom. I mean, God bless them. They should have electrocuted themselves. Thank God they did not. But I have definitely seen it. But by and large, they are good to these things. By and large, the operations take care of it, and certainly any damage is paid for, and then some. So. The 12-month factor as well. I'm kind of working down Brad's myth versus truth list here. The second thing out of people's mouth is like, oh, what happens in the summer? What happens over Christmas break? And the industry 30 years ago decided that this individual lease structure was going to be undergirded by a 12-month lease structure. So it doesn't matter if you graduate in May. It doesn't matter if you, second semester abroad. By and large, these leases are 12 months. Certainly there's replacements, there's subleases. I mean, there's always ways to kind of help people, but that's always kind of supported by a replacement contract. We're not in the business of getting paid for half the year or 9/12 of the year. Kind of keeping going with the myths and the truths. Some people think it's a university function or university affiliated, and the truth is these are private enterprises. This is private property. Now we're maybe symbiotic is more the term with the universities, because obviously they need us because they can't house all these kids. Some of these top tier, major tier 1 universities don't have anywhere near enough beds to house their students by a factor of 10. I mean, you have 40,000 enrollment universities that have 5,000 on-campus beds. So the demand that the supply demand fundamentals in these markets is truly typically, and obviously that's part of your diligence and part of us as operators, finding the favorable demand fundamentals in these markets. But typically the private off-campus suppliers these universities are begging for us. They're begging for us to be great product, well located, and truly a desirable place that their students can have an option to live. They can't house them. Universities have no interest in being developers. They have their 200-year-old little campus, and it's set in stone. Literally these old stone buildings. So we're happy to provide a service, and certainly a symbiotic relationship with the universities.
Yeah, and to play off that, we are looking for markets that they're actively going out to privatize their housing, right? And that's going to depend on some universities are landlocked. We're around a city, and there's absolutely no real good opportunity for them. Those are some of the items that we look for where they're reaching out for privatized housing. And then, as Biff mentioned, and a lot of our properties, because we're so well located due to our strategy, which we'll hop in here in a bit, but, we do host and, a lot of the athletic teams. And with that comes trust from the university back and forth. And it also puts us in a good light. I think that's an important part. Although it is private property, it's privatized. That relationship is still important, and we do a good job of, I believe we do a good job of maintaining that as a positive relationship back and forth. So, I mentioned the purpose-built properties, right? So a lot of times when again, going back to this animal house structure of like off-campus, an apartment next to a family with a newborn, those are the things that I worried about. How do you manage that? Well, it's just not the case, right? These are built for students. In fact, like not, you can imagine it's there. We're not trying to discriminate against anyone that wants to live there, but it kind of self sorts themselves, right? If you do have a newborn, you're not trying to live next to, the 20-year-old down the hall. It's you kind of already know what's built in store there. And when with that same on that same note, when you do choose to live in a student housing, which is really what the students want. This is part of their experience. They want to be surrounded by peers. It's safer to be surrounded by peers. The parents are happier that way. So it's, what we're saying again with student housing, it's not this random house out in town that, in our sense, it's a, again, purpose-built, mission-driven property.
And even further in that, things like bed bath parity, meaning 1 bedroom, 1 bath, 2 bedroom, 2 bath, 3 bedroom, 3 bath, 4, that kind of thing. In 80s, 90s conventional stuff, you'd have a 4 bedroom, 2 bath, or a 3-2, and those are just antiquated in today's purpose-built student market. Things like amenities, we personally have our own strategy that we'll get into here in a little bit. But college kids are here, like Brad mentioned. It's an experience. It's a rite of passage. It's a 4-year vacation to their school of choice. Hopefully, their school of choice, if not third or fourth choice, to have this experience that they've been told about since they were kids. And part of that comes with gyms and pools and volleyball courts and yoga studios and study lounges, and you can just go on and on and on with the list of amenities that can be found at these types of places.
Yeah, that's a great point, Biff. And again, it goes back to where you're not talking to the students, although that's part of it. You're also talking to the parent, right? They're the ones that are guaranteeing these. They want their kids to have that experience, but they want them to be safe. They want them to be surrounded by peers. So it's, you're speaking to both the student and the parent. A big thing when I zoom out and I think about, hey, this sector as a whole, and after COVID, I know kids are going to school online. I don't think that they're going back, and that is a narrative that I believe is why, because it's all hot air, right? Because their enrollment across the country is showing steady growth, and some universities more than steady. That is why there's been this large signal of the big players that you saw earlier that Biff had worked with, the Blackstones, the Goldman Sachses, the Scions. They're doubling down and bringing in more and more funds into this sector, because I think the secret's out. That myth was out there, this thought, this fear, and I know we're going to talk to COVID here in a bit, but they really didn't. Enrollment didn't really budge much as we thought, and in fact, while it's grown very steady since the pandemic.
Yeah, just to punctuate that. Yeah, COVID was a scare. It was a synthetic recession, and students specifically, we had no clue what was going to happen. I mean, that spring, it was all bets were off. That summer, we didn't know what universities were going to do. But that fall, I tell you what, I was on the front lines, and all these kids came back in droves. They didn't want to be on their mama's couch anymore back home. Their mama didn't want them on their mama's couch anymore back home. They wanted back to their home, which is their college town. They wanted back with their friends. They wanted back to, learning in person and all the, the lifestyle that comes with just living it up in your 4-year vacation that we discussed at these universities. So we did not know what was going to happen, but it proved to be the next evolution in the student space. I mean, the major equity of the world took notice of how the student sector performed through that trial, through those pressures. Major equity of the world is pouring into the space, and it already kind of was, but it was a force multiplier. And the way that applies to everyone on this call, you have access to the same strategies. You have access to the same types of assets. Now, you're obviously not a sovereign fund out of the Middle East or Canada or Singapore or some places that I've dealt with some of these equity partners too. But there are operators out there who look for retail investors. There are operators out there kind of like us that, we have some institutional equity, and we typically blend in our deals institutional equity with private retail investment, but that's who we are. That's where we play, kind of in that lower price point, mid-market space, which is exactly the vehicle and the reason why y'all are here on this call, is that you have access to the same types of strategies.
Yeah, I believe, piggyback off that, Biff, is once student housing came through with flying colors, that was the litmus test, right? That was the stress test that proved. And I want to bring back, historically, student housing is wildly recession resistant, right? So if you think about it, when you lose your job and you're out, historically, people go back to school. They pivot, they get a new degree, or they finish the degree that they started. And so historically, during recessions, you wanted to be in student. And so when student came through the other side of COVID, that's when, as Biff had mentioned, these private equities of the world started recognizing. And this is a quote here from Landmark's CEO. I mentioned how big they are, but you're talking about these big factors here, right? You've got this steady enrollment growth with increasing preferences for high quality purpose built. So I think now is better time than ever, right? So these big groups, they all have a playbook, right? There's these being well located, being in finding the spots with the enrollment growth, and being pedestrian to campus. These are the things that, and for them, a very large and very amenitized property. So they're seeing an amazing amount of growth. Also, the supply is moderated. So, right, think about that supply demand metric as you're rolling up. This demand is continuing to increase with enrollment growth, and the supply, because of the narrative that we kind of talk through in these myths, it kind of stays quiet, right? I mean, for the fact that Quest hasn't had anyone on here talking about student yet kind of proves the point. It's a quiet niche, and the demand continues to increase without any real pressure from supply to keep up. So we've been able to, similar to what Kurt was talking about with self-storage, 4 or 5 years ago, I remember how quiet self-storage was. Now self-storage is hot. And I believe that student housing is on the cusp of being very similar to self-storage in that sense. Yeah,
just to add quickly to that, we've mentioned demand fundamentals, market fundamentals, supply demand curves, all these economics 101 type terms. It matters, as y'all are learning, as you're absorbing this content, as you're doing your diligence, should you choose this vehicle or really any vehicle. These are the fundamentals. I mean, enrollment is up, supply is down. That's a favorable demand metric. That's the spot on the curve you want to be. I mean, these things matter. And as you're questioning operators, should you want to get into a deal like this, simple questions like, what is the enrollment trend? What are the supply constraints? What risk mitigators do you have in your deal, in your market? These are very, very easy questions that are going to tell you everything you need to know about the market. Demand fundamentals, how enrollment is, where enrollment's at, what supply looks like. That's going to feed into your market analysis with rates and your comp sets. I mean, it's all economics 101, and student is kind of, as Brad led at the top of the kind of the thesis is, student is no different than any space. Like there are good deals, there are bad deals, there are things you look out for, there are pitfalls, there is upside. But the thing about student is there are insulators. That's a word we use a lot. Things like enrollment, things like these state schools. Some of the states that we deal with have merit-based scholarships where they're feeding these, they're incentivizing these kids to stay in state. So they're feeding these kids these in-state scholarships, which is basically a direct subsidy to them and then to us, downhill to people like us, because these kids are subsidized to come find the best product in the market. Hey, I got a product for you, and the state is paying them to come live at my property. So I mean, there's just a lot of insulating factors. The deeper you dig into student, again, you got to do your diligence. There are bad deals in every market, but with a little bit of information and asking the right questions and understanding some of these risk mitigators, you truly have a vehicle that's kind of got some unique properties and some unique insulators.
That's a great point, Biff, because not every state offers something like that, right? And let me it's just imagine this, right? Your parents and you've been saving for your kid to go to school since they were a toddler, and sure enough, they decide to stay in state on a merit-based scholarship, and they get a full ride, and that's very standard. I know Biff actually used the Hope Scholarship in Georgia to go to University of Georgia through that scholarship. So now here you are, your kid has a full ride. Well, what do you put all this money towards? You want them to be in the nicest, safest, best located, housing that you can find, and so that's what Biff means. We are indirectly subsidized by the state government. And again, all this is funded across the United States. It's funded through the lottery. So, as those scratch offs and lottery, they're funding it. And I don't believe that any politician is going to run on cutting education anytime soon. So it continues to climb year after year. It's a great program. And so that is something that we look for as a group. And I think everyone on this call, if you don't need to go with us, but you should be searching for states that offer this type of scholarship, because it does, you've got very affluent, a lot of money towards the housing that's ready to be dropped on with our properties. Again, something that's just different than multifamily, right? You're not going to see something like that in your standard multifamily world. Yeah. Go for it, Biff.
Yeah, I think we kind of stole some of the thunder here. These are just some kind of some anecdotes and some kind of data that's undergirding some of the things we're talking about. Enrollments increasing. I guess this is probably we kind of walked you into that one, but those were some data and some anecdotes. And we really kind of jumped the gun on this one too. I mean, this is really just more reading and more data. Feel free to kind of peruse this as we're talking through. But the major equity of the world has taken note. Everyone's heard of Blackstone. I think they're pushing $20 billion into the space. I know they had a $13+ billion single acquisition of American Campus Communities, which is the largest owner operator. I think it's 150,000 beds or some astronomical number that Blackstone just snapped up, bought it outright. I think that was all 2 summers ago. I was part of a Blackstone recap with Landmark that was about, I think it was close to $1 billion, not quite, back in 2021. I've worked with sovereign funds out of Abu Dhabi, Canada, Singapore. There's just major equity in the space, and it's the old adage: follow the money. If those coffers are burning, have such a burning desire to be pouring into this space, clamoring for it, then something's going on. Again, how does that translate into your world? How does that translate into your, hopefully robust personal wealth, IRA type situation? It means you have to find deals that you have access to. You don't have access to Landmark and Blackstone's, $900 million monstrosity in Minneapolis or Atlanta or whatever they're building next year, but you do have access to $30, $40, $50 million boutique stuff in some of the markets that we operate, because that's exactly what we acquire. We put people like you in $50 million worth of this type of strategy last year alone, let alone the year before and the years forward. So you truly have access to these resources, and education is the first step.
And I want to go back to, there is a playbook with all the plays on how to be successful that Biff has been operating. And that's why when you look at this criteria, right, we say, hey, here's our criteria, these 4. We are absolutely positively laser focused on these criteria. And the reason is because this is very similar, if not almost exactly similar in some cases, to what these big groups are doing. And their success is very obvious. So why would we change the play, right? So our playbook is Class A, pedestrian campuses that I had mentioned, or to downtown. You've got these operational efficiencies, which obviously just keep it lean and efficient for us for our margins. And then you need to ensure that you've got this rent growth, whether that be through enrollment growth, but doesn't have to, right? We mentioned, and this is stuff that these other groups recognize too. If the demand is continuing to increase, but say there is a moratorium in this town in certain markets, which we've taken advantage of, or that the that there's the university is taking down one of their dorms, right? And so now there's going to be more people out in town, and they don't plan on building it. They want to convert it to an academic building. Now, these are the things that we look for. So it doesn't necessarily have to be enrollment growth. There's a lot of other factors that affect that supply demand curve. But again, these aren't our strategies. This playbook came from the big guys, and we tweak it to be the best we can for ours. And it's been, we're going to talk about our track record here in a second, but it's been wildly successful. And I think a lot of it has to do with Biff's background and with working with these groups. So let's talk through, the case studies that, we kind of just talked through these criteria of ours, but then we talked about the demand drivers, right? That in-state scholarship, not every state has it. So we make sure that the states that we're going into offer that. We do like to see the enrollment growth, but that barrier to entry, a lot of times there is a multifamily moratorium, which means you can't build for one reason or another, whether it's a density issue or the sewers can't keep up with the growth of the town, or whatever the reason is, it's keeping the supply down. That's what we look for. And that's part of this market analysis that's so important, wildly important. Just like you guys are doing your due diligence right now, we constantly are speaking, and a lot of that has to do with Biff's relationships through his time, but always speaking to operators and developers, and just keeping your finger on the pulse.
Yeah, and then I think, sorry, Brad, I think something too for you as individuals and investors and learning this and consuming this. Everyone has a different strategy, right? Ours, we prefer efficient. We don't like the highly amenitized Vegas style resort monstrosities. There's a place for that. They're highly successful. I mean, we just showcased the Landmarks and the Scions and the Core Spaces and those guys of the world. They're big, beautiful resorts, and that's fine. We prefer a little more lean, mean, location and product are our amenities. We just prefer an OpEx that we could push down into the 20s, into the upper 20s. We don't want $1 million shuttles and $10 million pools to operate and staffs of 25 people. We just prefer lean and mean. That's a strategy. I think you as investors and individuals should decide your own strategy criteria. Maybe you subscribe to lean and mean. Maybe you want, the full boat resort style amenities. Maybe it's more return facing. Maybe you're more risk averse and you're okay with value add type renovation, lease up, stabilization, a little riskier on the spectrum type risk, but also upside. Maybe you don't. Maybe you want Class A stabilized, lower risk profile, but more stable risk profile. These are all the questions you have to ask yourself, and certainly your operators, if you go to actually place money. But everybody kind of has different things that speak to them. Maybe it's certain markets. I mean, some people love the Sun Belt. Some people have a thing against Texas. I mean, I personally operated in Texas for a lot of years. I know there's all kind of treasure to be made out there. Brad alluded to it a few minutes ago, but there are some, in the world we live in, it's not a political comment, but there are jurisdictions that have landlord constraints versus there are jurisdictions that are more landlord friendly. That's just a fact. People tend to consider that when they're investing or they're developing or they're owning and operating. These are all just things you have to kind of consider when you're formulating your own strategy and you're vetting your own deals and markets and operators and assets.
Yeah, to go to that, right? So what you're seeing here was considered a cottage style student housing complex. So these are 4 and 5 bedroom homes that the students go in and live together, essentially in their own home. This is very hot right now. This is where a lot of students are driving through to. We're 100% occupied, actually, across every single one of our in our portfolio. And I think, yes, it has something to do with us and our strategy, but I think it has to do a little bit about student housing and the supply and the demand, just as a whole. But what you won't see in these pictures, as Biff had mentioned, is the huge Vegas style pool. And there's a place for it, but ours, we feel that the lean and efficiency is just as good. Really, location tends to be our amenity. You'll notice that everything is within a mile, and that's very important. And this is from talking to students and them giving us their feedback and why they liked it here, or why they wanted to move, or why they've stayed all 4 years. The beauty is with student is, you've got them, and especially for this property here, and this is fairly common for us, but you've got sororities in this one in particular, and they pass down their room to their little sister or a younger woman in their sorority. So, we don't actually have to go out and market a whole bunch, right? This is what I call evergreen, right? Not only is the market in the University of is Georgia College and State University going up for enrollment, so you're getting more people coming every year, but also we're not having to go out and find a ton of new students coming in. And then take a look at I love showcasing this, right? Pro forma is something that you're going for. That's your goal. We hit our goal. People are more than doubling their money in 5 years. And just, keeping in mind that, for me, I'm a ETF guy. So I try to double my money in the stock market in 7.5 to 8 years. So we're doubling our money in a little under 5 years with this. And we're actually doing better than that. And you'll notice on every single one of our properties here that we are outperforming the pro forma or our goal.
That's sorry, Brad, I'll stop it right there. Just talking about pro forma and some of these performance metrics, as you're formulating your strategy, as you're consuming this information and learning and deciding maybe on this sector or similar, you'll want to ask about track record. You'll want to ask about performance. I mean, if somebody puts a deal in front of you, your first question should be, who are you? What have you done? And show me, and so it's very important to understand people have to do what they say they're going to do. Now, in this time that we're in, this capital environment that we're in, it has been very, very challenging. Interest rates went bananas 2 summers ago. Cost of capital is way up. Equity is very timid. Maybe that's the word. Maybe that's a nice way to say it. It's just been hard to get things done. So I'll toot our own horn for a second. The fact that we're hitting pro forma and actually doing a little bit better, it speaks to the conservative nature of our underwriting. It speaks to just doing what we said we were going to do and having risk mitigated deals. Not to pat ourselves on the back, but you should find similar performance. You have to find people that do what they say they're going to do, and you have to ask them, what have you done, and show me. Period. If you take nothing else away from this, you have to make sure that you're vetting the owners and the operators just as much as you are the market or the asset or any kind of singular tidbit about the deal. You have to make sure that the people who are showing you these numbers have a track record and something that you can hang your hat on for performance.
Absolutely. It's a great risk mitigator, right? You need to know that they've done it. And when you have people, and Biff and I, we have a team of 6, right? And we have quite an experienced team, but you got to understand, when you have as many years under our belt as our whole team has as a whole, these are the questions you ask, because it's very difficult to say, hey, what could go wrong if this could go wrong? And if you look at experience and you look at track record, you can kind of rest relieved knowing that a lot of things bad have gone on and we've dealt with it, or whoever the sponsor team has dealt with it over the years. And that's the beauty of track record, because when I'm looking to place my funds, I'm thinking, I got to think of a good what could go wrong question. And the answer with track record kind of is a widespread answer of things do go wrong all the time. And yet, you'll see here, this is our Middle Tennessee State University, all above pro forma. And then our University of Georgia is all, again, same. But so, to keep going back to risk mitigation, it's just such an important piece of investing in real estate. And there's so many reasons why I love it. But there's an aspect to vetting and this due diligence that you guys are all here for. It's very important. And this is just our way of showcasing that we've dealt with a few items that have been difficult, and it continues. Again, here's another one with pro formas or actuals well over pro forma. So. And with that, that's we're up to Q&A right now.
I think it's time. The best part of the whole thing. We said our piece. We would love to interact. We would love to answer specific questions. There's no bad questions. It will foster more conversation, and we would love to hear anything in the spectrum. I know we kind of had some focus to our pitch on student space, but it's a deep and wide ocean. Would love to hear from y'all. Would love to answer any questions.
Yeah, or use us as a resource, right? If multifamily would, and again, I like the multifamily because of the scale, and if you have an issue in one unit, it's not going to ruin the whole thing. But if you're sitting there, you're like, I want to do this, I want to take a duplex, and I want to build it next to my alma mater, ask us those questions. I give the first person always a lot of props to be the first to ask a question. It's always difficult, but we're there for that too. We're here to help and educate. So by all means, fire away.
Looks like we're getting some. I'm happy to just read these and start kind of going through. Oh, wow, that's cool. It pops up. Typical exit strategies for student housing investments. That's a great question. That's going to be deal dependent. That's going to be business plan over business plan dependent. That is a question you need to ask directly. If a deal is put in front of you, or certainly as you're formulating your own strategy. If that's another one of those, I kind of listed asset type, markets. I kind of listed a few things that you should consider in your strategy, but the exit is another thing to put on that list. Maybe you don't want to hold long term. Maybe you want to hold 3 years or 3 to 5 years. Maybe you're in it for 10 years and you're okay with the illiquidity that comes with that, but the returns that come with that. We typically, and I can only speak for us because again, there's many different strategies. We typically go 3 to 5 years, sometimes 5 to 7. We're probably in that 3 to 7 kind of medium term hold. It's not a short term flip because that's not a thing really. If you're taking the debt that we're taking and some of the rent growth that we need, you need to turn over a cycle or 2 or 3 to really kind of hit the growth that we're targeting. But we also aren't holding forever. We want to get you paid and burn and turn and kind of get on to the next one. So 3 to 5 years for us is probably very fair, but you should definitely consider exit 100% in your formulation.
Hey guys, sorry to interrupt. I was having some computer issues again. So, I can take the Q&A. You guys can keep rolling either way. I just didn't want you guys to think that I had abandoned you at all.
No,
No,
let's keep rolling.
Let me touch on something too for those that are not multifamily literate. Valuation on these, when Biff's saying 3 to 5 years, valuation is very concrete. It's a reason why I love multifamily as a whole. And is because it's going to be based on, it's not an emotional driven number based on like the house next door, which when you saw that in 08, 09, valuations of homes dropped 35% sometimes. This is based on rent. So it's the net operating income divided by the capitalization rate. That is a very mathematical way of saying that depending on what you're bringing in for rent, and again, rent only went down 5% on average. I mean, that's even in the biggest markets for a student. Some stayed the same or went up just a little bit. But point is that it's very mathematical, it's very concrete, and it's less emotional in that sense. So the valuation, what we're doing over these 3 to 5 years is raising the revenue and decreasing our expenses for the net operating income to be a higher number. And then the market will decide the capitalization rate.
Got it. Point well said. Exit strategies. That's what everybody wants to know. What are the typical exit strategies for your housing investments?
Yeah, I think we hit that a little bit. It did look like there was a follow-up to exit strategies. We're basically 3 to 5 years. There's a range. You should definitely formulate your own strategy. Maybe you're a longer term hold and there comes profit with that. Maybe you're short term, that type of thing.
Well, I think too, the fact that it's not, in many cases not being ground up kind of lends itself to that 3 to 5 year hold. And again, going back to my storage background, I would assume or would guess that there's a vote on whether or not to sell from the members. And sometimes the cash flow is so good that it could be, hey, let's let this continue to ride. Is that something that you guys have seen in the operation as well?
Absolutely. Or maybe there's a refi horizon where we could refi out of a debt, 3 to 5 years is the debt maturity. And we could see where we're at and maybe a recapitalization with a refinance is absolutely an option, 100%.
I have a quick question before we get back to the other ones, because I'm, very heavy into higher education myself. And I agree with you, when there's downturns, recession, COVID, you see a spike in enrollment because people have time to do things. In terms of competition, if I have an apartment complex or self-storage, my competition is the guy or the company that builds a facility right down the street from me. And I'm sure you guys have that as well. But one thing that we see in the higher ed world that I see being involved in it is more of a movement to online education. How does that factor in when you guys are thinking about this in the long-term vision? Is it going to happen overnight to where campuses are going to be vacant? No. And it's never going to be the case where campuses are vacant, but it could have some kind of a dent in the enrollment. Is that something that you guys have factored when you're looking at building the plan, or is it something that's not even on your scope? Just out of curiosity.
The data tells and has told in the last few years post-COVID that impact is most impactful in kind of those commuter schools, kind of those below tier 1 type schools that are a little more regional, that are a little more highly commuter. The ones that are just
right,
not
more your urban core schools, like,
or just the ones that are near a major metro that a bunch of people can go to. That's not not tier 1 SEC, ACC, Power 5.
Gotcha.
Those major tier 1 flagship type universities and college towns. Those are always going to be a destination. Those are always going to be a 4-year vacation. Those are always going to be. They just are. I mean, we had kids even that first fall, that COVID fall. Most of the universities were totally online. They weren't even back in person. The kids just moved back to town. They were in their apartment going to online class back in town. I mean, that was the reality of the situation. So I think it matters the type of university. I think when you're talking about these tier 1 flagship universities, that's never going to be an issue.
Right. And then also kind of the secondary, suburban, tertiary markets that you guys might get into, kind of the same thing with being commuter. If you're in a secondary, suburban, tertiary market and you're going to school, odds are it's commuter, whether it's community college or university. So no, great answer. I just wanted to ask that because it's something that I know, on the private side, private universities are starting to come back. The smaller schools are starting to see that where it's more online based. So just curiosity of, is that a factor? But to your point, with the Power 5 schools and things like that, not so much. So no,
they're there for the sorority. They're there for the football. They're there for the downtown
the experience.
Yeah,
the experience, we'll call it. Yeah.
Mm-hmm. and some of that is too, Kurt, is undergrad, as Biff has mentioned, it's really does not affect in the schools that we target really at all.
Gotcha.
But graduate level, it hasn't taken it. It's still very strong, but that's where you're starting to see a little bit of give there. And the graduate level, hey, I'll get my master's online. But yeah, that's it. We're not seeing it in the undergrad.
And demographics probably would dictate that too. If somebody's going back for their master's or their PhD, in many cases, there's been a gap between undergrad team. They do that to where they're a bit more established in their career. Maybe they've got a family and those kind of things. So it's two totally separate segments. So that's excellent point and very well taken. Dolores has a question where she said she missed the first part. So thank you for joining when you did. Talking about your company, Burton Capital, is this a syndication investment company? Because she loves the concept of student housing.
Yeah, that's exactly who we are. We sorry, I muted myself. That's exactly who we are. We typically blend some institutional equity with retail equity in a syndication manner. So we, depending on the deal, depending on the business plan, depending on the market, depending on the asset, we typically have a custom mix of retail and institutional capital. So we fit people just like y'all into our deals, more or less.
Awesome. And I know Dolores's next question, what's the contact information? We'll add that at the end. I know that we have a slide on that. So for John Smith, follow up on exit strategies. Typically, is this asset acquisition target by a REIT portfolio, similar multifamily, for example? Like, who are you selling to at the end of the day?
I mean, the dream, what a question. The dream is that we package up a portfolio and sell a portfolio,
Yes.
as a bundle, as a branded, performed pack, because typically that has more value. Typically it's a turnkey portfolio. It's not just a one-off asset here or there. I mean, that is our goal. Who that buyer would be, it depends. I have sold to other major players in the space that are just the next guy over. I have sold to REIT types. Sometimes people getting into the space typically look at a portfolio pack because it's turnkey. They don't have to spend 2 or 3 years kind of fist fighting through onesie twosie, acquiring one, acquiring two. They can just buy a pack and boom, they're off to the races. So yeah, the player is probably dependent on our value and our markets and our performance, but the idea of bundling up a little portfolio and selling it off is exactly what we're doing.
When you guys talk about the REITs, and again, going back to storage, that's exactly what we did. We packaged 21 or 22 of the 26 and sold it to the REITs, because if you try to do one-offs to the big players, quite frankly, it's not worth their time. And I don't know how else to put it. They've got the appetite and the capital to acquire volume, and that's the volume play. So I think that's another excellent point is a REIT somebody you want to sell to? For sure. But the idea being it's multiples, 5, 10, 15 or more. And that's, as an investor, that's the windfall. That's the ultimate windfall, is when you can package them up. And it many times gives you even better rate of return depending on where each asset is in the life cycle. So that's something to consider as well. And again, going back to the original question, that all goes to a vote. I mean, the members vote. Maybe, no, why are we doing this? We'd be crazy to. The cash flow is so good. But if you could package a bunch, it's like, well, that's a no-brainer as well. And then you just rinse, repeat, do it all over again. Brent wants to know about an offering memorandum. I would assume just by reaching out to you guys' contact information that you guys have on here, that would be the way that they would get a hold of any kind of offerings that you guys have.
Yeah, we have past deals. If you want to see what we've done, we have future open deals. Yes, short answer, yes.
Awesome. Matt,
before we go on, just because we are talking with REITs, right? And REITs are was my first exposure to the real estate world, was these huge real estate investment trusts. And what you don't get that you do get with going with a company like ours, doesn't have to be ours, but any syndication, you're actually going to receive depreciation because you, no kidding, own a portion of that property. So you're going to get depreciation. You're going to what's called a Schedule K1 and a paper loss. After we do a cost segregation study, you're going to get a paper loss at the end for your tax year, the year before, and you don't get that in a REIT. And that's usually the big difference for those that are thinking like, oh, what the hell is a REIT? It's still a great vehicle for investment. Reaches out to a bunch of people. That's great, but I think the big difference is you're as an owner, you are able to participate in the depreciation of your owned asset.
Absolutely. And then a little plug for IRAs. A lot of times we get the rub of, well, I can't claim depreciation if I have an IRA. Well, you can if you're a passive investor in a syndication like this, up to the percent that you're debt leveraged. So you could argue pros, cons, whatever, but from an IRA perspective, it can make it even sweeter by doing that, because now that tax exempt entity can now get to claim some of that depreciation, write-offs, expenses, et cetera. So just a little plug for anybody who's considering doing this in their IRA. Don't be scared of potential taxation, because the write-offs are going to mitigate that to practically nothing anyway. Matt has a good question. This is talking kind of about the experience level of the operation. How many deals are you in currently, and how many have you exited? Have you ever lost investor capital? That's always a touchy question, a good question.
You're doing it. You listen to my advice, shake them down. Us as individuals, I come from 20 years of in other people's machines. So I have been at the table, for many, millions of these things. Now, us as Burton Capital, we're about 3 years old, Brad, not quite 3 years old. So we are in either as the main sponsor or as affiliate sponsors, 6 deals.
Yes. 6-ish.
And again, you have affiliations. I mean, sometimes you co-sponsor with people, that type of thing. None of those have gone full cycle yet. They're all in somewhere in their 3 to 5 plus business plan, just because of our age. But no, we have not lost anyone money today. We, as Brad stated, our portfolio is in great shape. Certainly in our student track, we just, because the cycle goes August to July. So we just moved everybody in. We just turned over the rent roll, and we were just tallied up all of our pre-lease and new occupancy and new rent roll performance. And we were 100% across the board and grew rents almost 10% across the board. I mean, couldn't have been happier with the year we just had. Now we get to start all over and do it again for the 25-26 pre-lease. That's, but yeah, great question. You should ask anybody you ever talk to. You should ask that question.
I would echo that from being in the syndication world, and though and it's an important distinction that you made. Burton Capital might be 3 years old, but if you look at the collective of the machine and the people that make that up, you're talking decades of experience. And that was a question we had at Pinnacle, because we were mid-cycle, none of the assets had matured to that point yet. So we'd get asked, well, you're only X number of years old. It's like, yeah, but collectively we got over 60 years of storage experience. So, we learned that from working for the big guys, the Life Storage, et cetera. And you start your own thing, you know what to do. And then once you do it, the point you just made, do it over again, do it faster, do it better. So I would, if I could say anything, it's that great questions, but also don't look at just the company age when you're considering whether or not to do it. Look at the collective of the people making that up and their track records of success and how they come together and fuse those great ideas together. That's what creates a winning organization and ultimately and hopefully a winning investment strategy. Steve wants to know, are we able to use 1031 exchange money into the fund, and are you in Indiana markets?
So kind of loaded. Yes, 1031 is absolutely investable. The problem is we typically need a 1031 to be kind of the main investor, or certainly early enough to where we can structure it properly with SEC kind of structure inside of our operating agreements and our entity structure, because it matters. I mean, I'm not an SEC legal expert, but you can't just add a 1031 in like like you're just a retail investor that's just cash per SEC guidelines. So are we 1031 capable? Yeah, everybody is. It just has to be structured in the way that the SEC will allow it, and will keep Brad and I out of an orange jumpsuit. Oh, and then, sorry, as far as Indiana markets, I've never actually operated much in Indiana. I was in a company that had some stuff in Bloomington, in Indianapolis, but me personally, I don't have much experience in Indiana, truthfully.
Typically, from what I've seen in my decade plus in the industry, when we're talking about investments in Indiana in particular, traditionally has been and historically has been a phenomenal single family home investment market, whether it's Indianapolis and the suburbs or even Gary, Indiana, because now you're getting into the Chicago metro. I know several investors over the years that they specifically go there. But to your point with student housing, haven't seen a lot, and the little bit that I've seen, haven't seen a ton in Indiana. Don't know why or what that is, but that's neither a pro nor a con, I would say. Talina, what type of Quest investors are you looking for? Beginners welcome.
All are welcome. We have very, very seasoned $1 million+ investors in the retail side, and we have 50,000 first time ever investors. We welcome the opportunity to, first of all, be part of this educational process, because you can't do anything until you've educated yourself. But yeah, we welcome all.
Yeah, to touch on that too. In fact, a lot of investors want to come in as what's called a limited partner. That's hey, I'm just an investor, and they want to see the rhythm. They maybe hop on a few calls and start to understand for themselves, to start to and maybe with the goal to do it themselves in a later date. But we definitely have plenty of investors come in with the hope to see, hey, I want to see this machine. I see your track record. I want to learn from you guys. I want to invest with it because now I've got, skin in the game. And so that's pretty common for us to have for our some of our beginner investors.
That actually got my brain going to work here on a question I have, is that let's say that you've got somebody who, not an investor, not an LP, no GP, nothing, but they bring a deal to you. They bring something to you. Has that happened before? Is that part of the growth, or is that even on the table as you guys continue to grow into the future? you got that boots on the ground, people kind of bird dogging, looking for properties. Is that something where you have people actively sourcing deals for you or looking for them?
I would say that is a thing out there in the space. We personally probably wouldn't be looking for that because that's kind of one of our specialties. Like our relationships and our access to deals is kind of honestly one of our separators. I mean, that we don't have a deal flow problem.
Gotcha.
We don't have an access to deal problem. We need capital. we need, we say no, so many times because of all of our relationships and the markets I've operated in, and we know developers. And I mean, that is a useful trait or value that someone could bring to an equation in a syndication, but that's not personally something we need.
Well, I'd say that's an excellent problem to have if the capital is the thing you're looking for, because capital is readily available. So I would say to the question earlier where you alluded to 3 years of experience, the fact that you guys have only been around for 3 years and you don't have that deal flow problem, that's a great statement about the status of the company and where you guys are going. John has a great question. Do student housing have any student housing specific provisions like rent control required by partnering schools or regulatory agencies?
That's a great question. Yeah. Oh, wow, that's a great question.
So there's the same, like we mentioned about, discrimination, right? A lot of times we get asked, we can't mandate it with provisions wise. I don't know, I'm not talking rent control, but we cannot mandate that a student will live in our property. In fact, in that Athens, Georgia, University of Georgia property, we have 2 empty nesters, believe it or not, just because the property is beautiful and the units are beautiful. But so there's provisions that student housing has to deal with like anyone else, discrimination wise, and but going to rent control. And here's the thing, the question about Indiana, we specialize and we focus in the Southeast. And I know Biff had said it, but in the Southeast, you do have more landlord friendly laws. And so this is more of a question, and we've kind of touched on California here recently as a company, but this is very much like a West Coast, California, Oregon, Washington type of question. And I personally not sure. I mean, lean on Biff if you've been out there. But
I think Brad's speaking a little more toward like fair housing is what you're talking about with some of those like who's your demographic or who can qualify. But I also see part of this question being kind of what we said, that this is private. These aren't affiliated with the universities. They're not controlled by the universities. It's a symbiotic relationship because we offer a beautiful place to live close to campus, and the universities have a place for their enrollment to live because there's no way they could house everybody. I mean, that's kind of the end of the relationship. So now I have seen and been near, haven't ever done one directly. There are some universities that do joint ventures with some of these student purpose-built developers, and Lord knows what's in those contracts. But typically we house their students, our students go to their university, and that's kind of it. Kind of short of some of those other ancillaries, I think is how I would finish that.
And follow up, I would guess that falls into, do these student housing also accept non-student residents?
Brad alluded to it. You can't,
Right.
like, student is not a protected class. That's what the fair housing law is, calls them protected classes, race, religion, sex,
Right.
familial status. I shorted a couple, but there's federal law that governs fair housing. And student is not typically a protected class, but also none of these operators, us included, we're never going to say you're a student, so you have to live here. You're not a student, you can't live here. If you qualify, if you can sign my lease and you can meet the qualification standards, meaning the credit check, the income verification, the same thing that financially qualifies anybody per the rental criteria. I don't care who you are, nor does the federal law. So that's kind of what supersedes that is federal fair housing law.
Good point.
Yeah, they kind of self-filter, right?
Brad mentioned earlier, it's a self-filter. There's a family is not going to live in an individual lease structure. A family that wants a 3-bedroom is not going to pay 3 lease contracts to live in a 3-bedroom that's individually leased. That's prohibitive.
Well, let me touch on something else that we didn't talk to actually, and is a big factor on why families and why student housing, this mission-driven student housing, is so awesome is because, say you're there, it's a 3-bedroom, property, and your buddy fails out, right? You know what you have to do in a duplex now? Guess who's in charge of the entire rent? You are, because your buddy failed out, or your buddy had to leave, or they transferred schools. A litany of things that could happen. Well, in this structure, and why this is so popular, is it doesn't matter. Your lease is for your room. Obviously you're going to have a different roommate, but you're not financially obligated to pay or pick up anything that goes on within your unit other than your lease and your specific room. And that's a big protection that parents really appreciate. And it's, I think, is a big reason why there's this drive towards this mission-driven student housing has been so successful. It's a big protection people enjoy, because that stuff happens all the time.
You guys invest in any other asset classes or just student housing?
We have some conventional. We're actually about to launch a conversion, a hotel to market rate conversion that's kind of been an entitlement for a few years. But frankly, for 2 full years now, we have been solely focused on student. Now, obviously, I come from student. I've been solely focused on student for 20 years. But to answer your question directly, Burton has dabbled in other multifamily, but we are focused on students more or less.
Makes sense with the growth and how you guys have outlined it in the presentation. It's not necessarily saying stay in your lane, so to speak, but you got a good thing going. If it's not broken, don't break it.
Do one thing, do it well,
right?
And yeah,
do it better than everybody else, and just keeps the flow. Do you have any investment options that do not have UBIT? Let me jump in as the IRA specialist. When we're talking about passive investors with their IRA investing with Burton, we're not talking about unrelated business income tax, because the IRA account holder is not running a business. It's a passive investor. What we're talking about with this is that subset of UBIT called unrelated debt finance income, where it simply means that your IRA could, I say could because I'm not a CPA, I'm not a tax attorney, I'm not the expert in that piece of it. Your IRA could pay taxes up to the percentage that the asset's debt leveraged. But going back to what I was saying earlier, this is now where the IRA would get to claim depreciation, write-offs, expenses, et cetera, up to the percent that the asset is debt leveraged. So you're not going to get 100%. If it's only 60 or 70%, for example, the IRA can only claim that much. But just by doing that, you've significantly reduced the tax liability to the IRA. So this is the big distinction. UBIT is if the IRS deems you're running a business inside of your IRA. If your IRA is an investor with Burton, you're not running the business. You're just a limited partner. You're a passive investor. So big distinction there. Last question here from Christy Long. What markets are you seeing with this growth? And you've already alluded to this. Are you currently in Texas markets? You're heavily invested in the Sun Belt. So I'll let you guys answer this and we'll wrap it up.
It's great questions. I operated in Texas a lot of years with those big developers. I mean, San Marcos, College Station, Lubbock, just to name a few. We're not opposed to Texas, but we don't currently have anything on the board in Texas. It's a little far for us. Brad's in Florida. I'm in Atlanta. So, TBD. What markets are we seeing this growth? We are in Athens, Georgia. We've done some serious looking in Tuscaloosa, Clemson. Obviously, we're in Murfreesboro. We showcased that one. That's basically Nashville, if you don't know where Murfreesboro is. Tallahassee. So, the Sun Belt. And we learn about new markets every day and kind of their current market fundamentals, the enrollments and the supply and demand. So yeah, just to name a few, really anything that's going to be top tier is worth a look. It depends on the asset. Now, if it's 4 miles away and it's, highly monetized, the old adage is, why do they have a shuttle? Why do they have the $1 million pool? Because they have to, somebody put them 5 miles away from campus. So they had to build all that crap. So they had a prayer of getting people to go out there. Whereas we're looking for opportunities that are pedestrian to campus. I mean, that's really more of everything's kind of downhill from that. Then we dive into market viability, enrollment trends, risk mitigators, supply constraints, all those, any of those things that can tick a box for us as far as a risk mitigator. But
that's a great point, because you're picking markets and cities and states where the populations are growing, where people are moving to. And, it isn't just empty nesters or seniors that are moving, it's people with families. So it's ideally situated and ideally suited. the places you mentioned, Tennessee, South Carolina, Florida, Georgia, are all seeing massive population spikes. And they're all in that top tier. What you said, the Power 5 schools are all in those markets. So it just makes absolute sense why you'd be focused on that, because follow the population, yes, but also, like you said earlier, follow the money. It's the classic adage. So go where the opportunity is.
Yeah. So you could find 30 markets just in the Sun Belt.
Oh, 100%. 100%. Even not just the Power 5, but you also have kind of the tier like 2 schools and even the high Division 2 that still have huge populations. So guys, this was amazing.
Real quick, because the cost of living is so low in college towns, we are seeing a lot of regular multifamily movement. And in the sense of Murfreesboro outside of Nashville, that town's blowing up like crazy. There's a lot of student, sometimes it converts from student to multifamily because those student properties were too far away from campus, and they can fill up in multifamily. So again, those are those quiet supply demand metric moves that when we're looking at these markets, that's something that we will look and see for, and that's definitely the case in Murfreesboro.
That's awesome, guys. Well, I can't wait to have you guys on again. Again, this is a topic that has not been touched on. I think it's been a little bit underrepresented, but glad that we've got the introduction to you guys and that you are now part of our education platform. This is very, very popular, and I think that it's only going to be an asset class that grows. And like we said offline, I think in this market, people have their eyes up and they're looking for different investment strategies. They're looking for things that have an element of stability and predictability. And this checks those boxes. And it's just such a smart play, because higher education's not going anywhere. Colleges aren't going anywhere. People are always going to go, whether it's for the actual academics or if it's for the actual experience. Either way, you guys have created a machine to where it ensures investors are getting paid, because regardless of the reason why they're there, it's 12-month leases and it's going to be paid like clockwork. Say your guys' contact information one more time so everybody can grab it in case they have future questions and how they can get more involved with you guys.
Yeah, it's just one. Thanks again, Kurt, and this is so fun to talk to you. Especially,
I think you cut out, Brad.
I did cut out. I was just saying, contact at burtoncapitalgroup.com is the easiest way to get a hold of us, and it goes to it blasts everybody. So that's our. Let's see if I can just present it here.
Yeah, I was trying to chat. I guess I got to join. Yeah, he said contact at
burtoncapitalgroup.com.
Thank you
everybody for coming.
Chat right
great
now.
questions.
Yeah, I was going to say the same. Thank you all for this opportunity. It was truly a pleasure. We really appreciate the opportunity to speak to everyone, and love to run it back sometime soon. And I wish everybody tremendous success in your journey. It's a journey.
Awesome, guys. Well, thank you again so much, Ken. Thank you for your time and the education. I think that this is going to be one of the more popular ones that we've had, and then those repeat viewings are going to be allowing this to grow. So thank you guys again for your time. Look forward to seeing you guys soon.
Thanks, Kurt.
All right. Have a great day, everyone. We'll see you guys next time.